I've been trading with the RSI for more than 10 years, and in this video I will show you my 4 favorite RSI trading strategies. And in part 2 of this video we will cover things like what are the best settings, is the indicator lagging, and we're going to cover the question, does it work? So let's get into today's video. And the first strategy is a support and resistance range trading strategy, and it's really interesting because we can actually use the RSI to find out when is support and resistance likely to hold and when can we expect a breakout. And what you can see here is that the market was in a strong uptrend, and during this uptrend here was a local high, and when the market made that high the RSI was trading at 80, and then the market came back into this level a second time, and that time the RSI was only 65, and obviously as you can see the resistance held. And the RSI is a trend strength indicator, so it measures how strong has a previous trending move been. And what you will often see, not always and nothing works 100% of the time, is if the market comes back into a previous high and low, and the RSI, such in this case for resistance, is not greater than the first time the market made that high, there's a very good chance that this level is going to hold. And this is a great way how we can use the RSI to our advantage. Here is another very interesting case study. So on the left, the market was here in a downtrend. And at the bottom of the downtrend, the RSI made a low of 15, which is a very bearish setup and a signal. And the market came back to this level a second time, tried to actually break out, but the RSI was at 35, so significantly higher. And this RSI indicated that the market was not as weak here, so there was not a lot of selling interest. And we can also look at the other end of the range. So here was a local high that the market made when the RSI traded at 65. And the price came back, and the RSI that time was at 70. So it is higher, not much, but it is definitely higher. And you can see that the market did break out, performed a retest. During the retest, the market stayed quite high here at the RSI as well. And then the market was able to trade higher. So a very interesting way of how you can actually use the RSI to get an idea and a feeling for support and resistance level and how strong is the market trading around such levels. Here another very interesting case study. The market traded higher. The RSI was at 80 when the market put in this top. The market traded lower, came back to it, and never reached 80, not even came close. 65 was the highest point that the RSI was at this area. And you can see afterwards the level held. And when we look a little bit further to the right, you can see that the market sold off. Where did it sell off into? Into a previous low. This low was made when the RSI was at 30. Here the RSI traded at the same level roughly and also made a 30 low, and the market didn't break out. So you can very nicely see of how we can use the RSI, and this could for example be an additional rule for your trading criteria, so you get a better idea of when do you trade a breakout, when do you stay in a range, and that could really help your trading out a lot. Next is another super interesting one, and strategy 2 is a breakout RSI strategy. So what are we looking for? What we're looking for are ranges both on the price action area of the chart and also on the RSI. So here you can see the price action gave us this really nice downward shaping trend line. We can connect the lows here, and we would essentially get a triangle. The market has been consolidating for a long time, and at the same time the RSI was trading here below the 50 level. So there was this resistance level on the RSI that was never broken. And as long as such a range on the RSI and then the price action is holding, you should not trade anything that would suggest a long breakout. So long trading ideas would be very wrong here, because the market is clearly in a range and there's no strength here as the RSI indicates. However, shortly after, you can see the market did break out of the trend line, did break out above the previous highs. And at the same time, the RSI also gives you here the breakout signal. So the RSI essentially, and any indicator for that fact, is actually a way of objectively having another additional layer of confluence in your trading, because indicators provide objective numbers. There's not as subjective as, for example, a trend line or a support and resistance level. Indicators are super 100% objective, so they are really great add-ons for any trading strategy. Here you can see the market then kept following through, it traded into the previous high, and you can see when this market made the high, the RSI was at a 70 level. However, when the market approached here the previous highs, the RSI was trading definitely above 70, around 80, and you can see the breakout then succeeded and the market actually went higher. And so this is a very nice way of also giving your trade confidence. If you, for example, would have traded the breakout, then you probably would have thought, should I take profits here or no? You could have, for example, scaled out a little bit, and then as the RSI suggested there's a lot of strength here, you could have maybe extended your target a little bit. Another great example, here the market is in this wedge or megaphone pattern, whatever you want to call that. So we have a trend line at the top, we have a trend line at the bottom, and the RSI also has here this support level. And as long as the support level holds, and as long as the market is trading in those boundaries, you should not do anything, because trading in those tight ranges is just very, very dangerous, and you're going to lose a lot of money because it's unpredictable. The market may bounce at every little price point. However, once you see that the market is breaking out not only above the low or below the lows, also through the trend line, and also making a lower low here on the RSI, here you can see it very clearly. This is now a signal that the bearish side is completely taking over. So now if you're a breakout trader, now would be a much, much better time to get in, because now you're going with the momentum. You have a lot of confluence on your side. You can trade with a lot more confidence, and that is how you can structure your approach. And you can see afterwards the market really fell through, and it all started here with this breakout, and the RSI really helps you to distinguish between when you should be sitting on your hands, which a lot of traders have problems with, and when is actually the time to get into a breakout approach. Strategy number 3 is a divergence strategy, and I've been trading an RSI divergence for many years, so let's get into this. And when we just look at the basic definition of a divergence, it just means, as the name suggests, that the price action and the indicator are diverging. They are making two different things, and in this case it means that the price action is making lower lows as indicated here, and the RSI is making higher lows. So although the price action may indicate that here is a downtrend and the downtrend is being continued because the market is making lower lows, the RSI already suggests that there is not a lot of bearish pressure behind it, and the sellers are not really strong. And the RSI knows that because it looks at the trend strength, it looks at how strong are the bearish candles, how many bullish candles do you have, and how strong is the market pushing into a new low. So the RSI divergence really tells you that there's a big heads up, and you should not probably get into more short positions. And if you are in a short, maybe it's a good time to get out of the trade, or slowly at least unwind it. Because very often you can see that the market may not be initially completely taking over after a divergence, but it's a very big heads up, and very often you can see the market is entering a consolidation afterwards. And then you can see afterwards we have this wedge pattern here, or the channel, and then after the market is breaking out of it, then you can see the complete reversal. So an indicator divergence is often the first signal to a complete trend change that may happen later in the future. So very interesting signal. Here another case study, the market was very strong here, made a lower low, but the RSI already indicated that be careful, the RSI is making a higher low, so there's not a lot of selling interest here in the market anymore. And what we could do is, for example, draw in the last significant high. So here was the last high the market made. And an idea would be, for example, now to wait until the market gets above that and then look for long opportunities. So here you can see the market is making a high. It's also breaking out of this pattern here that we are drawing on the RSI. So you can see there were two previous resistance levels that the market put in here at the RSI. We have the divergence, and then on the breakout you can see everything is really nicely falling into place. And you can see afterwards this is what happened. The market didn't completely reverse initially, but you can see we have another very nice channel here. We have a beautiful channel here on the RSI, and then on the breakout you can see that is when the trend starts. So divergences are not often the complete starting point of new trends, but they are often the end point of existing trends. And this is where new trend following traders should start following a market, because then you may be able to get into those new trend following trades very early on, and those can give you great reward to risk ratio scenarios. The fourth RSI strategy is a pullback trading and divergence approach. So this is going to be really interesting. And for that, we are going to add another moving average to the chart. So we're using here a higher time frame moving average. The price action comes from the 15-minute price chart, And the moving average comes from the 4-hour. It's a 50-period EMA, as you can see here in the top left. And what this does is that the moving average sets the direction. So as long as the market is trading below the moving average, then we are only looking for short opportunities. If the price action would be above the long-term and higher time frame moving average, then we would be only looking for long opportunities. So the moving average is basically a filter for us to determine what are we looking for, buying or selling opportunities. And the next step is then that we look for pullbacks on the lower time frame. We want to look for the market going up and move close to the moving average, and at the same time give us a divergence signal. So you can see we have a bullish move, which would be against the downtrend here indicated by the moving average. So we are waiting for this downtrend to be over. We can already see that the divergence is here in place. So the RSI is making a lower high and the price action is making a higher high. We are drawing here our trend line in, we have our support and resistance flip zone here, and now we only need to wait for the market to break lower. And this is what happened afterwards. You can see the market broke out with a strong, or two strong momentum candles that broke out. The RSI indicator is still here, the divergence, and afterwards you can see we have a trend following entry. So we're going with the higher time frame trend because we have determined a higher time frame with the long-term moving average. We wait out on the lower time frame here for the bullish pullback to be over, and then we want to get into with the trend following entries with a breakout approach. Another example here, again, we are trading below the higher time frame moving average. We have our lower time frame divergence here. The market was in an uptrend, but not very strong here, obviously. We have the higher highs, we have the lower highs on the RSI. We draw our support and resistance level. So basically, we just want the market to break out of this tiny range here. We have our strong breakout candle, which is the key. You always want to make sure that your breakout candle is very strong and it's not just crawling over it. In this case, you can see the market 1, 2, 3, 4 candles didn't do anything. And then we had this huge engulfing candle. So another great confluence. And if you don't trade the initial breakout, that could have been a re-entry opportunity because engulfing candles with the trend are always indicating, or not always, but are indicating strong momentum, and they are very powerful candlesticks in general. The first question that always comes up for indicators is it lagging? And I really want to open your eyes for indicators, because indicators are not really necessarily lagging. Because if we are saying that indicators are lagging, we also have to say that price action is lagging, and especially technical analysis. When traders talk about lagging, they mean that the signal is coming too late and the price will already have moved before the indicator will indicate it. However, this is not true. The indicator is taking the price action of the past 4, 5, 7 candles. In the case of the RSI, 14 candles is the default setting. So it will look at the past 14 candles and provide a very detailed analysis, because the RSI looks into the trend strength, it looks into how strong are the bullish candles, how strong are the bearish candles, what is the average gain on the bearish candles, the average gain on the bullish candles, what is the ratio, and then it will provide you with a reading of how strong is the trend. So this is a very helpful and objective way of analyzing price. And the same thing happens when you're looking at price action. For example, you're looking at a flag like here, or you're looking at a head and shoulders. And what is the head and shoulders doing? It looks at dozens and dozens of candles in the past. Assuming here's where we have the left shoulder, you can see until we have the right shoulder and the break of the neckline, we have probably around 15, maybe 20 candles. That's more than what you get from your RSI. Here on a flag pattern, we are only able to draw the flag pattern once we have here our low and the last touch point of the trend line. And we probably have around 20 candles here of the flag. So price action is looking at past information that has already happened. Same as the indicator. Indicators look at what has already happened, because that's the only thing traders have at their disposal. There's nothing that traders can do anything else besides looking at what has already happened Then you make an analysis of what has happened and you try to find patterns that have repeated in the past, and then you bet on them and hope that it will play out in the future with a very similar expectancy. And this is trading in a nutshell. So indicators are not more or less lagging than price action, and lagging is not even a bad thing, because lagging is everything that we have as traders. Everything that we use for analysis, even if it's just a candlestick, the candlestick has already happened. And it is lagging for that matter if you want to define it in that context. So indicators are great tools, they are objective, and they can really, really nicely enhance your decision making. Is it working? Are indicators working, or should you just stick to price action? And I always have to refer to Martin Buzzy Schwartz. And he was featured in The Market Wizards, and he also wrote the book Pitbull Champion Trader, or Pitbull Trader Lessons from Wall Street Champion Day Trader. And it is my absolute favorite trading book. And Marty Schwartz won the World Cup Championship, I think, 4 times. And I believe he turned 40,000 into 20 million US dollar. And he was using indicators in his trading. In his book, he was talking about the indicators that he was using, explaining how he would use it. And many other of the market wizards, I believe also the turtle traders, many of them have used indicators. And it's really important that you open your mind. You're not as close-minded to indicators as the normal and average trader, because that's a very, very destructive and a bad way of approaching your trading. Indicators can very nicely enhance your decision making. So don't close yourself off from this great opportunity. Find the right indicators, study indicators, what they are doing, how they are analyzing the market, what is the information that they provide, and then you can integrate it into your trading strategy and really nicely improve the quality of your analysis.